From the war in Ukraine to increased interest rates and steep prices at the pump, some economists believe a recession could be imminent. I'm Ariana Bennett.
I'm Kristen Remington. Thank you for being with us. That's exactly right. They're keeping their eye out. And even if a recession is inevitable, it's important to look at all the factors, including what to do if one, in fact, happens. Brian Hoffman breaks it all down for us.
Syndicated officials were close to approving a 50 basis point rate hike, but settled on 25 points due to the uncertainty around the war in Ukraine. Many believe the next round will be closer to that 50 basis point hike come May, leading Deutsche Bank to be the first bank to predict a market recession. But what exactly does that mean?
A recession is 2 quarters of negative GDP. So if our GDP just declines slightly, instead of having a 2% growth per quarter, all of a sudden we're declining by even 0.5%. That's considered a negative GDP. Happens twice in a row, and there we are.
The other factor that some economists are looking at is the interest rate paid by bonds, which historically is higher the longer the bond term is. You can see the 5-year marker is lower than the 10-year marker. However, as you can see right here in red, this is an inverted yield curve where the 5-year bond pays out more than the 10-year bond. This is what happened briefly this week. As you can see from this chart, the yield curve, when rates have converged, has predicted 5 of the last recessions or economic difficulties. As you can see right here, we see that downturn. Here, you see that downturn. And we are right about here. But it's important that you don't just look at one factor when talking about potential recessions.
To have the best perspective is don't take any one indicator as a solo performer. Take many indicators in chorus, such as the ISM Manufacturing Index, which right now is at 57.1.
Meidel says that any number for the manufacturing index above 50 is a sign of the economy in an expansion. And when you look at the jobless claims, which are sitting at just about 166,000, which is the lowest that we've seen since 1968, this also leads one away from the recession scare. We're also seeing lower prices for a barrel of oil than we saw a month ago.
We're not going to see the reflection of that decline in the pump yet because we still have this inventory that has been purchased at higher rates.
This, of course, is not financial advice, and I am not a financial advisor, but Meidel does tell me that there are things that investors can proactively do right now.
I think investors today have to take a hard look at what they own and be more selective in what they own. And so that means today, shorter term interest rates on their bonds.
Covering the story, Brian Hoffman, 2 News.